Welcome to S&P Indices podcast service, regularly reporting on the market performance, product innovations, and thought leadership that bring a global perspective to your local marketplace.
Hello, this is J.R. Rieger with a special Rieger Report, Defaults and Diversification in the Municipal Bond Market. To illustrate the municipal bond market, we're going to be talking about two different indices. We're going to talk about current default trends. Sector and size of the deal seems to make a difference. We'll also touch upon two key types of municipal bonds, general obligation bonds and revenue bonds. We'll talk about sectors in the municipal bond market. We'll talk about state and territory issuance of debt, and we'll talk about quality within the municipal bond market. For the municipal bond market, a quick overview. There are over $2.8 trillion in municipal bonds outstanding, according to the Federal Reserve. There are tens of thousands of different issuers of municipal bonds. There are approximately 1.5 million different municipal bonds outstanding. There are two major types of municipal bonds, general obligation bonds, or GOs, and revenue bonds. And within the revenue bond sector, there are many different types of subsectors. Each has a different risk profile. Overall, essential purpose revenue bonds, such as utility bonds, have a different risk profile than that of single revenue stream bonds, like multifamily bonds. Municipal bonds can be issued by municipalities from all states and territories, and the quality ranges can range from AAA all the way down to default, as rated by S&P, Moody's, and or Fitch. And many municipal bonds are actually not rated by a nationally recognized statistical ratings organization. The two indices that we'll be talking about as an example to illustrate the municipal bond market include the S&P National AMT Free Municipal Bond Index and the S&P Investor Tools Municipal Bond Index. The S&P National AMT Free Municipal Bond Index is an index designed to be used as an investable benchmark for municipal bond ETFs, or exchange-traded funds. The index design is for it to be investable. It includes only investment-grade bonds. Bonds must have a rating of S&P BBB-, Moody's Baa3, or Fitch BBB- to be included in the index. The bonds must have a deal size of $100 million or more at issuance, and for a bond to be included in the index, it has to have a par amount outstanding at each monthly rebalancing of $25 million or higher. Only tax-exempt bonds are included in this index, but it does include some sector exclusions. The sectors that this index excludes includes conduit financing, or industrial development revenue bonds, or economic development revenue bonds. It excludes multifamily housing bonds, and also excludes uninsured healthcare bonds. Some key statistics for this index are that it tracks over 8,400 different types of municipal bonds and has a total par value of bonds in the index of $544 billion. The other index that we'll use to illustrate the municipal bond market is the S&P Investor Tools Municipal Bond Index. This is a broad index used by mutual funds for performance measurement and attribution analysis. It has a simple objective: measure the broad municipal bond market. It includes all bonds of any quality, and it has defaulted bonds all the way up to AAA quality bonds. There is no deal size criteria to be included in the index. However, each bond must maintain a par amount outstanding of at least $2 million or higher at each monthly rebalancing. Bonds can be tax-exempt or subject to alternative minimum tax to be included, but there are no sector exclusions included for this index. There are, however, structural exclusions such as floating rate note bonds and derivative municipal bonds are excluded from this index. The key statistics are that it tracks over 56,000 municipal bonds with a total par value of over $1.2 trillion. So let's begin to take a look at default statistics. we'll use the S&P Investor Tools Municipal Bond Index with the broad benchmark index that tracks over $1.2 trillion in municipal bonds, and to start our discussion about default statistics. In measuring defaults, we are talking about bonds that have defaulted on their promised principal or interest in part or in full on the date it was promised. So if they missed that principal or interest or made only a partial payment, we categorize it as in monetary default. The number of bond deals in default in the S&P Investor Tools Municipal Bond Index at the end of November 2010 was 184 different bond deals, up from 156 deals at the end of 2009. Those 184 bond deals represent total par value of $6.57 billion in face value of debt. As a percentage of all the par value of bonds in the index, that represents 0.52% of the par value in the index. That's up from 0.42% at the end of 2009. Let's take a look at some sectors. In the S&P Investor Tools Municipal Bond Index, we've highlighted some key sectors, and historically, the municipal bond defaults have come from four types of sectors: the conduit sector, the multifamily sector, land secured or special assessment sector, and the healthcare sectors. That historical trend seems to be holding for 2009 and 2010, with 2010 seeing a dramatic increase in land secured or dirt deals going into default. In looking at monetary default statistics for the entire year, this includes all bonds, whether they are in the municipal indices or not. We see that there's been 99 municipal bond deals going into default through November 30th of 2010. Nearly 100 bond deals. The majority of those 99 deals are represented by the four sectors we've been discussing: land secured or special assessment, healthcare bonds, including hospital bonds, multifamily bonds, and industrial development or conduit financing type issues. Those four sectors make up the majority of municipal bond defaults so far in 2010. Looking at the statistics even deeper, we can see that those four sectors, special assessment or land secured, industrial development or conduit financing, healthcare, and multifamily, make up the majority of the monetary defaults that have occurred through November 2010. But we can also see that non-rated deals made up 82 of the defaulted deals so far in 2010. When we used ratings, we looked at all three rating services, S&P, Moody's, or Fitch. If the bonds were not rated by any of the three, we considered it not rated, and 82 of those non-rated deals have defaulted so far in 2010. Let's look at size of the deal. Using the same statistics, we can see that the majority of bond deals that have defaulted in 2010, 89 in fact, have been from a deal size of $50 million or less. Only 5 deals have defaulted that are over $100 million when it was originally sold. So the size of the deal seems to have an impact on the default risk associated with a municipal bond. Let's take a step back and look at the two major sectors of municipal bonds: general obligation bonds and revenue bonds. When we're referring to general obligation bonds or GOs, we're referring to bonds backed by the full faith and credit of the issuer and the taxing power associated with that issuer. Revenue bonds are bonds issued for and backed by specific projects and are backed by specific revenue streams. We can see that in the investable index, the S&P National AMT Free Municipal Index, general obligations make up 29% of that index, with revenue bonds representing about 68% of the index. In the broader benchmark index, the S&P Investor Tools Municipal Bond Index, general obligations represent 20% of the index, and revenue bonds represent 77% of the index. Mostly smaller revenue deals are contributing to that difference. Let's take a deeper look into sectors. We'll be using the S&P Global Data Solutions sector classifications. And with this graphic, we can see that there are many different types of sectors. And within those sectors, many types of subsectors. For example, healthcare can mean hospital bond. It can mean nursing home bond. It can mean a drug rehabilitation facility. It has many different subclassifications. But we can see, using this graphic, that transportation, utility, tax revenue, and various purpose general obligation bonds make up a large percentage of the bonds in the investable S&P National AMT Free Municipal Bond Index, while the broader benchmark index, the S&P Investor Tools Municipal Index, has more of an equal weighting of sectors going across. The sectors that it does include those sectors that have the majority of defaults. That include healthcare, housing, and conduits, where the S&P National has excluded those sectors from the index entirely. Let's look at the bond market from a state of issuance perspective, and the way we're measuring this is by par amount and by bond number of bond issues in the indices, and it could be any bond issued within the state, whether it was issued by a local government or a state or a state authority. So the numbers are representative of the state's entire municipal bond issuance. And we can see that the major states that are issuing municipal bonds are California and New York, and as well as other states in the news, such as Illinois, Massachusetts, New Jersey. These are the large issuers of municipal bonds, and the indices reflect that statistics. Let's look at quality of the municipal bond market as measured by the indices. To review quality, we'll only focus on S&P ratings. And when looking at the S&P ratings in the investable index, the S&P National AMT Free Municipal Bond Index, we can see that most of the bonds are A-rated or higher. There are bonds that are not rated within this index by S&P, but they must be rated by Moody's or Fitch to be included, and those ratings must be investment grade. Within the S&P Investor Tools Municipal Bond Index, we do see that there's 14.5% of the bonds are not rated by S&P, and when doing this same statistical analysis for Moody's ratings, is about 17% is not rated by Moody's. So there are a good slice of municipal bonds that are not rated by any nationally recognized statistical organization, and in this index, the ones that are rated below investment grade represent about 2% of the index. So quality is a key defining factor within the municipal bond market. So in summary, we've talked about defaults and diversification in the market. When we've talked about defaults, we highlighted that sectors make a difference. Size of the deal can also make a difference. We talked about the large municipal bond market with many different issuers and many types of bonds outstanding. There are many types of municipal bond sectors, each with different characteristics. Bonds have been issued from all states and territories, so there's a lot of different bonds available. And the quality of municipal bonds can range from AAA all the way down to default, with many bonds that are not rated by any nationally recognized statistical organization. You can find more data on the municipal bond market by going to www.seymour-indices.com or www.standardandpoors.com, or if you're a Bloomberg user, SPX Go. This is J.R. Rieger with a special Rieger Report, Defaults and Diversification in the Municipal Bond Market.
This podcast is available on our website, www.podcast.standardandpoors.com. If you have comments or questions about our program, please do not hesitate to contact us. S&P Indices can be emailed at sp_indices@standardandpoors.com.